Do you ever have that feeling like you know something huge is about to happen, and then bang, the script just flips completely? Well, what if that something big is the stock market? And this really complex trading system you're relying on has to slam on the brakes and do a total 180, like in a matter of hours. Today, we're taking a deep dive into exactly that. It's a fascinating look at high stakes market strategies, and we're focusing on one specific protocol called Alpha Core V3.16. We're going to explore how it tries to use what it calls an information advantage to predict market moves, and more importantly, what actually happens when even super advanced systems like this have to hit the panic button and make an emergency recalibration. We're talking real time, high pressure stuff, big potential gains, big potential losses.
That's spot on. And our mission here in this deep dive is to really unpack the documents we've got. They detail AlphaCore's whole strategy for one critical, kind of nail-biting weekend, September 5th through 8th, 2025. We'll look at how it analyzed key things like Bitcoin, the S&P 500 ETF, that's SPY Tesla or TSLA, and the VIX, the volatility index. So we'll trace its initial predictions, which were very bearish, very confident, and then watch how these crucial overnight shifts in the data basically forced it to say, hold on, correlation breakdown detected. And then how it pivoted completely. A totally new bullish stance. And this whole saga, as you'll hear, it really teaches some deep usable lessons about how markets work and honestly how vital human discipline is, even with automated trading.
Yeah, and it kicks off with this concept Alpha Core calls the weekend edge. The core idea seems really smart, actually. Gain a 40-plus hours information advantage. How? Well, by watching Bitcoin really closely over the weekend because, Bitcoin trades 247 to try and predict and then exploit a Monday gap down in the regular stock markets. The goal was ambitious, aiming for like a 3-5x profit multiple against uninformed traders. But it's not just prediction, is it? It sounds more like a super disciplined framework for making decisions under pressure, almost military-like. Okay, let's dig into that. So AlphaCore V3.16. It wasn't just watching, it was in full weekend crisis mode.
Yeah.
Described as operational, synchronized, and armed. Sounds intense. The system was basically convinced a market crash was coming Monday. What were those early signs?
Yeah, armed is right. And that conviction, heading into the weekend, it was backed up by some pretty specific, pretty alarming signals from those four key assets. This was Friday, September 5th, and carrying through the weekend. And what's really fascinating here is the VIX, the fear index. On the surface, the VIX itself closed Friday pretty calmly, 15.18, but under the hood, in the options market, whoa, it was screaming something totally different. These out-of-the-money VIX call options bets on the VIX spiking specifically for October 8th, they just exploded. The VIX W16 call surged. Get this, plus 31,800%.
Wait, 31,000%.
Seriously, and it came with this extremely high implied volatility, or a fee, of 197.88%.
Okay, slow down. For listeners, why is that specific options activity, that insane jump, so much more telling than just the VIX number itself? What does that high implied volatility really mean here?
It's absolutely critical. Because VIX calls, especially the ones far out of the money, meaning their target price is way above where the VIX is currently trading, they're basically huge bets on a sudden sharp spike in market fear and volatility. When they jump like that, with that kind of massive VIX, now, VIX reflects the market's expectation of how much the VIX itself might swing. This wasn't just random trading, a huge flag. It strongly suggests, as the document puts it, someone knows something. Big institutional money, positioning aggressively for a significant event, an imminent and significant volatility spike. The math actually put an 81.74% chance on the VIX being above 16.70 by September 10th. That was a key trigger for a hedge inside AlphaCore. It's like getting a peek at the big players' betting cards before the flop. Shows you the real sentiment before it hits the headlines.
Okay, so the VIX options market was flashing bright red, setting a really ominous tone. How did Bitcoin fit into this? That was supposed to be the weekend edge, right?
Right. Bitcoin was central to the initial bearish plan. The whole strategy was predicated on a BTC collapse over the weekend. They estimated a 70% probability of Bitcoin dropping below $109,480 by Sunday night. Now, interestingly, on Friday, the Grayscale Bitcoin Mini Trust ETF, that's BTC, the stock symbol, it actually closed looking bullish. It was up 1.69% at $49.44 and had a really low put-call ratio of 0.29.
Okay, low put-call ratio usually means more people betting on the price going up than down, right? More calls than puts. So that seems positive, contradicts the collapse theory. How did AlphaCore square that?
You're exactly right. Normally, it is bullish. But this is where the system sophistication comes in. AlphaCore's trap detection protocol was successful. It had this built-in veto logic. It essentially looked at that bullish ETF signal and said, hold on. It confirmed it as a false signal, a momentum trap. Why? because its deeper technical analysis of the actual underlying Bitcoin showed bearish patterns that contradicted the ETF's surface move. And this is really key for you to grasp. The system's power wasn't just seeing signals. It was its ability to doubt itself, to invalidate a seemingly good signal based on deeper conflicting data. It saved the operators from chasing a bad lead, so it correctly avoided taking a long position on Bitcoin, kept the capital safe.
Wow. That's more than just analysis. It's like automated skepticism, detecting traps, not just signals. Okay, so Bitcoin trap avoided. What about the broader market, SPY and Tesla?
Well, for SPY, the S&P 500 ETF, the picture seemed clear. After hours trading on Friday, I already saw it dip down to $645.96 from its $647.24 close. That fit perfectly with AlphaCore's expected SPY gap to 644-645, which they gave an 80% probability. Plus, technical indicators like a negative MACD suggesting weakening momentum and high volume on that decline seemed to confirm a short-term bearish trend. Then there was Tesla, TSLA. It was initially viewed as a potential amplifier. It actually had a strong bullish day on Friday, closed up 3.64% at $350.84, apparently driven by some Elon Musk news. But after hours, it pulled back slightly to $349.38, and that triggered a divergence alert. So AlphaCore's instruction was cautious. Stay neutral on TSLA puts. Don't bet against it yet until correlation confirmed. It would only become a short target if the whole market turned down as expected.
Okay, so summing up the picture going into that Monday morning, AlphaCore is seeing potential Bitcoin collapse, SPY already weak and expected to gap down, VIX options screaming danger, and TSLA showing divergence. It really does sound like all signs pointed to a major market downturn. The system was armed and ready. What could possibly go wrong?
Exactly. It looked like a textbook setup for a Monday gap down. But, the market loves throwing curveballs, and this raises that critical question for you. What happens when your perfectly laid plan starts falling apart overnight? AlphaCore was ready for this possibility, at least mechanically. It had its unified weekend monitoring dashboard, watching BTC, SPY, VIX, and TSLA constantly with these specific weekend checkpoint schedules, nonstop monitoring.
And here's where it gets really, really interesting. Because despite that heavy bearish conviction, by early Monday morning, September 8th, the pre-market data started to just, shred the original thesis. It wasn't just one thing. It was a wave of contradictory information. For instance, looking back at late August and that Friday, the overall market breadth was actually pretty healthy. The advanced decline line, which just measures how many stocks are going up versus down it, was trending higher and breaking out to new highs. That showed really broad-based participation in the ongoing market rally. That alone was kind of a contrasting backdrop to the whole gap down idea. The NYSE had 1,772 stocks advancing versus only 1,006 declining. That's solid bullish breadth.
So even before Monday, there were whispers of underlying strength.
Precisely. That underlying strength was like a quiet descent against the loud bearish signals AlphaCore had initially locked onto. A subtle but important red flag. And then came the loud contradiction. The actual pre-market data Monday morning. Right. The corrected pre-market numbers for September 8th showed SPY at $648.66. That wasn't a gap down, it was a gap up. A plus 1.42% jump from Friday's close. The documents say this confirmed the bullish breakout thesis, and remember, AlphaCore integrates other systems. Well, one called Apex Protocol, which looks at market sentiment. It flipped to bullish for SPY, said it was trading above key moving averages. And another system, DOTAS V2.0, which spots momentum breakouts. It also confirmed a key breakout for SPY. I mean, the world literally turned upside down from Friday's expectation.
And it wasn't just SPY acting alone, it was across the board. TSLA, remember the amplifier for the downside? It had an even more dramatic turnaround.
Unbelievable. TSLA gapped up to $355 in pre-market. That's a massive plus 4.16% jump from Friday's close. Totally contradicted the bearish TSLA thesis. Apex Protocol flipped bullish on TSLA too, saw a momentum breakout, and Bitcoin, the linchpin of the collapse theory. It showed a plus 0.36% overnight gain, 111,053 bullish divergence. The system read that as legitimate institutional buying. No collapse, just the opposite. And the VIX, the one screaming danger through options, it was still calm in pre-market, around 15.19, just further undermining the whole imminent crash idea.
Yeah, and connecting all those dots, that continuous pre-market monitoring, especially what they call the 6.06 a.m. verification, was absolutely make or break. Without that real-time data feed and the system's ability to react, it would have walked right into catastrophic short positions based on a thesis that was demonstrably wrong by sunrise. That was the moment. Correlation breakdown detected.
Loud and clear. The entire foundation of the weekend's bearish strategy just evaporated.
So what does that mean inside AlphaCore? You've got this system, operational, synchronized, and armed for a crash. and suddenly the enemy isn't coming. In fact, the opposite is happening. It had to execute a complete U-turn, right? Not just tweak things, but a full 180.
Exactly that, a full 180. It triggered what's called an emergency recalibration. The system acknowledged the overnight data for Bitcoin, SPY, TSLA, completely invalidated the bearish thesis. The expected SPY gap was officially revised to gap up. TSLA wasn't diverging down, it was showing a momentum breakout upwards. And the speed is what's really remarkable here. AlphaCore immediately pivoted to full bullish execution mode. That meant killing all the previously planned put positions, the bets on prices falling, wiped clean, and instantly established a whole new set of setups, this time for bullish plays, betting on prices rising.
That level of strategic agility is, well, it's stunning. For a human trader, flipping bias that fast, that completely is incredibly hard. There's ego, confirmation bias. How did AlphaCore manage it? What allowed it to make such a rapid, reliable reversal?
It really boils down to having these predefined protocols and that crucial veto logic we talked about. Once that correlation breakdown signal was confirmed, the system didn't debate, it just followed instructions. It automatically suspended the Apex protocol because the whole idea of bear convexity profits accelerating faster on the way down was now invalid. Instead, it activated DOTA's v2.0, the system specifically designed to hunt for and capitalize on breakout momentum to the upside. Then it set up the new trades. For SPY, it shifted focus to buying call options, aiming for prices above $650. Specifically, the SPY SEP 09648C and SPY SEP 126555C calls, but only entering if volume confirmed the move. For TSLA, same story, shifted to calls like TSLA SEP 09355C or the SEP 12345C350C, targeting levels above $355, again, waiting for volume confirmation. And interestingly, it even introduced VIX puts betting on volatility going down, the VIX SEP 0914P. The idea was to enter these if the VIX actually dropped below 15 at the open, basically betting on continued calm, the exact opposite of the original VIX strategy.
Bitcoin ETF calls were also added, but as a potential tactical-only play if the ETF broke above $49.50, where spot Bitcoin held above 113K. But it still kept Bitcoin somewhat in a neutral bearish gatekeeper role for hedging, interestingly enough.
Okay, so it's not just buy everything, it's specifically targeting upside momentum. The documents mention capturing upside convexity. What does that actually mean in practice? How's that different from just making a standard bullish bet?
That's a really sharp question, and it highlights a key part of the strategy. A simple bullish bet just makes money if the price goes up, maybe linearly. Upside convexity capture, though, is about structuring trades, often using options so that your profits accelerate disproportionately if the market makes a strong move upwards. It leverages something called gamma density concentration. Gamma, in options, basically measures how quickly an option sensitivity to price changes its delta accelerates. So by targeting key SPY levels like 648 to 652 where there was high gamma density, the system was aiming for spots where other market participants might be forced to buy, like dealers hedging their own options positions, potentially creating a feedback loop that fuels much bigger, faster upside moves. AlphaCore's positions would then capture amplified gains from that acceleration. It's about playing the market mechanics, not just the direction.
That's definitely next-level thinking. But even with all this sophisticated tech and strategy, the documents keep coming back to risk management and, crucially, the human psychological side. These protocols seemed absolutely vital during this whole chaotic pivot.
They're the safety net, the foundation. Remember those initial kill switch scenarios? Like, if SPY $647 and VIX 15.5 is exit all, if the market had started moving against the bearish thesis before the full recalibration, those kill switches would have triggered automatically. They would have saved the day, preventing huge losses. It underscores the idea. The system's rules are more important than sticking to a busted idea. And after the pivot to bullish, the kill switch was updated. Exit all positions if SPY was $645 or VIX 16.5. Always defining the point where you admit you're wrong and get out.
So there was always an escape hatch, a pre-planned exit strategy, no matter which direction things went.
Always. And the graduated exit strategy was consistent too, whether playing puts or calls.
Yeah.
The principle was, take profits methodically. Exit 25% of the position at plus 50% profit, half at plus 100%, 3/4 at plus 150%, and let the rest run with the trailing stop around plus 200%. This forces discipline. It stops you from getting greedy and letting winners turn into losers, or from holding on too long. You lock in gains systematically. And beyond the mechanics, AlphaCore explicitly prepped its human operators for the emotional chaos of Monday morning. They literally mapped out the emotional sequence Monday. expected. 9:30 a.m., adrenaline spike at gap open. 9:35 a.m., FOMO to add more size. 9:45 a.m., fear of position goes against. 10:00 a.m., greed as profits accumulate. 10:30 a.m., exhaustion from intensity.
That emotional sequence Monday, that's brilliant because it's so real. I think anyone who's traded or even just watched markets closely can relate to that sequence. Adrenaline, FOMO, the fear of missing out, fear, greed. Is this alpha core basically admitting that even with their amazing tech, the human operator can still be the biggest variable, the potential weak link?
I think that's exactly it. You can have the best algorithm in the world, but if the person pushing the buttons panics, or gets overconfident, or deviates because of emotion, the whole thing can fall apart. That's why these protocols aren't just code. They're about reinforcing the human mind. To fight those very real emotions and ensure execution was swift and unemotional, operators were given these discipline mantras. Things like, the system is the system, targets are targets, size is size, rules are rules, and maybe the most important, tomorrow is another day. It's all about reinforcing strict adherence to the plan, no matter how wild the ride feels.
Really drives home that human discipline remains critical, maybe even more critical when you have a powerful system tempting you to override it. Okay, so the system pivoted, the human was prepped. How did this new breakout momentum strategy actually perform in those first couple of hours on Monday, September 8th?
Well, first, the system itself, through something called the profit nexus, actually flagged some position sizing concerns right at the start. It recommended cutting the initial size in half. So for the SPY calls, instead of risking 7% of allocated capital, it said start with 3.5%, $65 rather than 7%, until volume really confirmed the breakout. That shows a focus on capital preservation first, even in a bullish setup. But even with that cautious sizing, it worked. By 10:34 a.m. Eastern Time, SPY was holding that breakout zone around $648.79, up about 42.4% on the day. The system logged a total profit on SPY calls of plus $31. That represented a plus 30.3% average gain across the 3 contracts that it entered. So solid percentage gains on the new bullish direction.
Okay, positive results on SPY calls, even starting small. What about TSLA? It had that huge gap up, but you mentioned it was potentially a weak link.
Yeah, by 10:34 a.m., TSLA was at $351.88, up 0.30%. But the system noted it was a weak link, losing momentum at that specific moment. And here's an interesting wrinkle. Despite the big pivot to bullish calls overall, one specific trade record shows closing at TSLA $350. Put a bet on the price going down for a small profit of plus 4.24%. Plus $25. That probably suggests some very quick, agile hedging right around the open, or maybe closing out a residual position from the pre-market plan that briefly went into profit before the main bullish trend took over. It shows extreme tactical flexibility. Overall, for that early period, the total realized profit across these initial trades was plus $56. And the win rate, 100%, 44 trades profitable. Even though the dollar amount is small due to the reduced sizing, it demonstrated consistent convexity capture, making money in the unfolding momentum even during a massive strategic pivot. It wasn't about hitting a home run immediately, but about methodically executing profitable trades according to the new plan.
What an incredible journey, really, inside the mind of an adaptive trading system. From confidently predicting a crash to completely reversing course and capturing a bullish breakout. Alpha Core V3.16 really demonstrated the kind of speed, flexibility, and discipline needed in today's markets.
It really did. And this whole deep dive, I think it offers some critical takeaways for you, whether you're an active trader or just trying to make sense of market noise. First, markets are just incredibly dynamic. What looks like a sure thing on Friday can be totally upside down by Monday morning. You always have to be ready for your analysis to be wrong. Second, that weekend edge, that information advantage, its real power wasn't just the prediction, it was the veto logic. The ability to invalidate its own thesis based on new data, that saved it from those momentum traps. Recognizing a false signal is just as important as finding a real one. Third, the VIX. Yeah, it's the fear index of the powerful signal. But don't just assume VIX calls mean the market must go down. Volatility can spike on strong upside breakouts too, as the potential shift to VIX puts showed. It measures the magnitude of expected moves, not just the direction.
And the final lesson, the one that seems to cut across all the tech.
It always comes back to discipline, doesn't it? Ultimately, sticking to your predefined system, including those kill switches, those graduated exits, those discipline mantras, that's paramount. Especially when emotions like FOMO and greed are screaming at you to ignore the plan. It really is system over ego.
This deep dive hammers that home. You have to continuously monitor, be ready to adapt, and maintain strict discipline no matter how smart your system is or how confident you felt about your initial call.
So, Maybe the next time you hear someone making a really strong, confident prediction about where the market's headed, ask yourself, okay, but what are the contradictory signals out there? What could possibly prove this wrong? And maybe more importantly, how quickly is that analysis or that system prepared to completely pivot if the evidence suddenly flips? That adaptability might be the real edge.
Great final thought. Stay curious, keep learning, and join us next time on The Deep Dive.